let's just dive right into the bedrock of this data. Welcome back to Iron Financial, the only explainer you need to cut through market weakness and forge an absolutely bulletproof portfolio. I'm your lead analyst, and today we're looking at a legacy retail giant that is trying to navigate a wildly uncertain, almost chaotic spending environment. Right now, we're dealing with tapped-out consumers, massive whiplash from hyperinflation to sudden disinflation, and relentless interest rate pressures that are just squeezing the middle class. We're doing a complete, ground-up teardown of Kroger's Q1 2026 earnings report. Under their new leadership, specifically CEO Greg Foran, Kroger is actively attempting to restructure its value proposition in real time. Make sure you hit subscribe because we are going microscopic on the financial mechanics today.
And I'm the market skeptic. Look, I'm here to represent you, the audience, because quite frankly, I need to know if the narrative Wall Street is spinning actually matches the raw math. We hear terms like resilience and value creation thrown around by executives every single quarter, but we need to see the actual blueprints. Is the structural integrity of this business actually holding up under the crushing weight of this macro environment? Or are there hidden fractures?
And that brings us to the absolute core question for today's teardown. We are looking at a massive, sprawling grocery chain operating in an intensely competitive space. Is Kroger a true defensive fortress that can weather any economic storm you throw at it? Or, when we peel back the layers, is this just a low-margin trap waiting to completely break? Let's be crystal clear about what a low-margin trap actually is. It's when your business runs on razor-thin profitability, so any stall in foot traffic or sales volume can immediately trigger a total collapse of the bottom line. The structural integrity just evaporates.
That is exactly the framing we need to use today. To determine if this is an iron fortress or just a trap, we have to meticulously examine the strategy management is executing to reinforce their market position.
Lead analyst Greg Foran laid out the current playbook without any ambiguity at all. He said, and I quote, "Our focus is clear: to become America's best grocer. We are lowering prices and sharpening our promotions so value is easy to see." They're deliberately choosing to take their operational savings and reinvest them directly into lower prices at the shelf. They want to defend the perimeter, protect their base, and ruthlessly regain market share from competitors. Market skeptic, okay, wait. Lowering prices. I have to stop you right there. Because whenever a CEO of a grocery chain, a sector that literally fights over pennies, says they're intentionally lowering prices, my alarm bells start ringing. In retail, lowering prices is almost always a race to the absolute bottom. Are they doing this from a position of overwhelming structural strength, or are they bleeding market share so badly that they're basically forced to discount just to trick foot traffic into the store? Let's get to the top-line revenue numbers and see what the raw data actually tells us. Well, let's look directly at the sheer scale of this foundation. Q1 2026 total sales hit $46.1 billion. That is up from $45.1 billion in Q1 of 2025. That represents a 2.2% growth on the absolute top line. Look, moving $46 billion of physical product in a single 12-week quarter proves that the core retail engine is a massive heavy lifting machine. I mean, the logistics required to achieve that kind of scale is nothing short of an industrial marvel.
Hold on. We need to drill down into the microscopic data here because total sales include fuel, right? And fuel prices are incredibly volatile. They mask the actual health of the core business. If we look at identical sales, or ID sales, excluding fuel, that top-line growth suddenly drops to just 1.0% year over year. And honestly, to get a truly clear picture, we have to strip out both fuel and the recent divestiture of Vitacost. When you isolate the absolute bedrock organic retail operations, that growth is a microscopic 0.5%. 0.5%! I mean, that is practically flat. It's virtually zero growth.
I hear you, I do, but you have to look at the broader context of the macro environment. The bull case here is top-line resilience. Delivering 0.5% positive organic growth while you are actively and intentionally deflating your own prices to win customer loyalty, that is a monumental feat. To drive positive dollar growth while unit prices are actually dropping means they are actually moving significant volume and stealing market share. They are pouring concrete and building a lasting moat.
Or actually, scratch that. Let's look at the bear case. The bear case is that the core retail engine is completely stalling out. If you are slashing prices at the shelf and you still can only squeeze out 0.5% core identical sales growth, it means your underlying volume isn't compensating for the massive discounts. You aren't actually moving significantly more units. You're just treading water. And in legacy retail, treading water is the first stage of structural decay. The foundation isn't growing. It's just sitting there, waiting for a crack.
Okay, fair point. But top-line growth is only phase one of the construction. Let's move deeper into the profit engine to see exactly how efficiently they are monetizing that $46 billion foundation. Boom. Just absorb this number. $1.4 billion. Specifically, $1,407 million. That is the GAAP operating profit for the first quarter of 2026. Look, this isn't an adjusted metric. This isn't manipulated by some creative corporate accounting. This is raw, generally accepted accounting principles operating profit. When you talk about a fortress, you have to understand that a fortress requires constant, massive cash flow to maintain its walls. Generating over $1.4 billion in pure operating profit in just 12 weeks proves that the core logistical engine is throwing off tremendous amounts of raw cash. And to further illustrate the sheer heavy lifting capability of this operation, let's look at the gross profit pool. $10,473 million. Over $10 billion. For a seasoned trader, this is what actually matters. This gross profit serves as a massive reservoir of capital. It allows management to seamlessly fund those massive SG&A expenses, continuously reinvest in store remodeling and supply chain capex, and still aggressively return capital to shareholders. The financial scale here is absolutely undeniable.
Look, the absolute dollar figures are huge. Yes, no one is denying Kroger is a corporate behemoth, but in a true financial teardown, massive absolute numbers often hide severe structural decay. $10 billion in gross profit is fantastic, sure, but how efficiently are they extracting that gross profit from the $46 billion in top-line revenue? We have to look directly at the margin rate.
And here is where I see a massive, potentially fatal crack in the armor. Kroger's Q1 gross margin contracted from 23.0% in Q1 of 2025 down to 22.7% in Q1 2026. Well, it's a 30 basis point drop. Exactly. A 30 basis point drop on a $46 billion revenue base is absolutely devastating. That is roughly $138 million in gross profit that just evaporated into thin air due to margin compression. Let me ask you this. How many boxes of cereal, how many gallons of milk do you have to sell to make up for $138 million in lost margin? Millions of units. If your top line is stalling at 0.5% organic growth and your margins are actively shrinking, that is the exact textbook definition of a low margin trap. The profit engine is leaking heavily. Okay, let's calm down and look at exactly what caused that 30 basis point compression before we declare the fortress breached. Management was extremely clear about the specific headwinds. First, the mix impact of higher fuel sales naturally drags down the aggregate margin percentage. Second, we have higher nationwide transportation costs. Third, egg deflation. This one is fascinating. When the price of commodities like eggs drops rapidly, you are making fewer absolute dollars per carton, even though the fixed costs of refrigeration and handling remain perfectly identical. But the absolutely crucial point is the fourth factor: planned price investments and associate wages. They are intentionally raising average hourly wages to over $26 an hour when you include benefits. This isn't a leak. This is deliberate structural reinforcement. In a highly competitive labor market, paying a premium is a defensive moat against union strikes and costly employee turnover. They are fortifying their labor force to secure the perimeter.
You call it structural reinforcement, I call it a permanent drag on profitability. Wage increases are incredibly sticky. They literally never go down. I'm still not convinced this isn't permanently weakening their core bottom line.
Then let's bridge that exact margin debate directly to the bottom line, because the earnings per share tell a completely different story of incredible resilience. GAAP diluted EPS came in at $1.46, but when we look at adjusted diluted EPS, we hit $1.58. That 12-cent delta is vital. Adjusted EPS strips out all that non-operational noise, things like one-time corporate restructuring costs or non-recurring legal expenses, to reveal the true operational strength of the ongoing business. Despite the 30 basis point margin compression you're panicking over, and despite the massive wage investments, they still delivered a highly robust $1.58 in adjusted earnings per share. The machine is actively engineered to absorb these exact macro shocks. Market skeptic. All right, I'll acknowledge to the $903 million in GAAP net earnings attributable to the company. Earning nearly $1 billion net in a single 12-week quarter is a very solid concrete pour. But I am genuinely incredulous right now. The math still feels far too tight. If traditional retail margins are actively compressing and core traditional grocery volume is basically stalled at 0.5%, what exactly is doing the heavy lifting to keep this bottom line so intact? Something else has to be aggressively subsidizing the grocery aisles. Now, you are asking the exact right questions, and this is where the Iron Financial teardown gets truly exciting. The traditional grocery business isn't acting alone. It's being heavily supported by reinforced steel beams in the digital space. Look closely at these bright spots.
Adjusted e-commerce sales surged 19%, driven heavily by their rapid under 1-hour delivery solutions. Next, Kroger Precision Marketing. This is massive. Profit here jumped by over 20%. Think about what this actually is. They aren't just selling groceries anymore. They are collecting granular, high-value purchase data on millions of loyalty card shoppers and monetizing it by selling targeted ad space directly to mega brands like Kraft and Pepsi. It is literally a high-margin tech business quietly hiding inside a legacy grocery store. And the ultimate milestone, e-commerce, including the media business, officially reached net profitability for the first time in company history.
Okay, I have to concede this specific point. Achieving actual net profitability in grocery e-commerce is notoriously difficult. Usually, things like grocery delivery and curbside pickup are massive loss leaders that just slowly bleed the core retail business dry. If Kroger has successfully crossed the threshold into true e-commerce profitability while simultaneously growing digital sales at a whopping 19%, that is a legitimate structural win. However, I do have to warn the audience, e-commerce margins, weighed down by those brutal last-mile delivery costs, will never match the high margins of a customer just walking into a physical store and pulling items off the shelf themselves. So it's a win, but it's an expensive one.
Let's pivot to the balance sheet, because a fortress isn't strong if it's built on a mountain of toxic liabilities. Look at this absolute debt load. Net total debt stands at $14,340,000 million, over $14 billion in debt. We are no longer in a zero interest rate environment, folks. The cost of capital is incredibly high, and the pure interest expense of servicing $14 billion is a massive, persistent cash strain on the foundation. How can you possibly call this a defensive play with that kind of crushing leverage? Because you are operating like an amateur by only looking at the absolute dollar amounts of debt. A seasoned trader looks at the business's capacity to carry that weight based on its cash flow, and the ratios prove Kroger's balance sheet is literally made of iron. Focus on the net total debt to adjusted EBITDA ratio. They are currently sitting at a leverage ratio of exactly 1.75x. Now, deeply contrast that against management's stated target range of 2.30 to 2.50x. They are operating significantly below their own target leverage. Their adjusted EBITDA is so massive that the $14 billion in debt is effortlessly serviced. More importantly, operating all the way down at 1.75x gives them billions of dollars in strategic dry powder. They have massive untapped borrowing capacity. They could theoretically hit the debt markets tomorrow, borrow billions of dollars to make a massive acquisition or ruthlessly defend market share, and still remain perfectly within safe foundational bounds. And speaking of utilizing that financial strength, management is aggressively deploying it. The board just approved an additional $2,000 million, $2 billion in share repurchase authorizations for fiscal 2026. As an analyst, I absolutely love this. But you have to understand the mechanics. Reducing the sheer number of outstanding shares with that $2 billion will artificially boost the earnings per share in future quarters. It's a brilliant capital allocation move that immediately rewards shareholders, even if it does slightly mask the stall in organic sales volume we discussed earlier.
Okay, I will admit, when you combine a massive new $2 billion buyback authorization with their explicit statements expecting dividend increases over time, it constructs a highly compelling shareholder yield argument. For those digesting the data right now, shareholder yield is your dividend yield plus your buyback yield. Even in a chaotic, highly inflationary world, if a company is consistently buying back stock and raising the dividend, they are returning hard, cold cash directly to your portfolio. It definitely offsets some of my deep fears about that microscopic 0.5% organic growth rate.
So let's synthesize the data and wrap up this teardown. We've drilled straight through the blueprints today. Let's stack the numbers rapidly. On the bull side, you have a massive $46.1 billion revenue base generating $1.4 billion in pure operating profit in just 12 weeks. You have a true fortress balance sheet operating at a highly conservative 1.75x leverage ratio, which is well below targets. And you have high-margin digital ad businesses surging by over 20%, finally pushing e-commerce into true profitability. And on the aggressive bear side, the physics of legacy retail are just undeniable. Against that $46 billion top line, core organic growth is crawling at a miserable 0.5%. Against that incredible operating profit, the gross margin actively decayed by 30 basis points down to 22.7% due to huge wage costs and commodity deflation. The traditional grocery aisles are under intense siege, and they're essentially relying on digital tech ads to mask the stall in the core volume.
Which brings us back to our ultimate question for you, the Iron Financial subscriber.
After seeing all the microscopic data today, the 30 basis point margin compression, the massive $1.4 billion in cash generation, and the ironclad low debt ratios, what do you think? Is Kroger the defensive fortress you absolutely need to stabilize your portfolio, or is it a low-margin value trap that will inevitably crack under the immense pressure of a stalled sales cycle? We've given you the raw numbers, the mechanics, and the complete structural teardown. Now it is your turn to forge your own portfolio. Drop your final verdict in the comments below right now. Is it a fortress or a trap? Thank you for joining this explainer, and we will see you on the trading floor for the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.